If you've ever felt overwhelmed trying to pick individual stocks, or you just don't have hours every week to research companies, there's a tool that millions of everyday investors use to build wealth without needing to be a Wall Street expert. It's called an ETF, and by the time this video ends, you'll understand exactly what it is, the different kinds you can choose from, what it costs to own one, and how to avoid the mistakes that trip up so many beginners. Quick heads up before we start. This video is for educational purposes only and isn't personal financial advice. Let's start with the basics. An ETF, short for Exchange Traded Fund, is essentially a bundle of investments, most commonly stocks, packaged into a single product that you can buy or sell just like a regular share of stock. Instead of spending your time and money picking out one company at a time, you purchase the entire bundle in one transaction. And because it trades on an exchange, you can buy it, hold on to it, or sell it anytime the market is open, giving you the same flexibility as trading an individual stock, but with instant diversification built in. Now, ETFs aren't all the same. To make sense of them, it helps to think about three different lenses: how they're managed, what part of the world or market they focus on, and how they deal with dividends. Let's go through each one. First, management style. This splits ETFs into two camps, passive and active. Passive ETFs are the most common choice for everyday investors, and for good reason. These funds are built to mirror the performance of a specific index rather than trying to outsmart the market. So, what's an index exactly? Picture a sports league table that ranks teams by performance. The strongest teams sit at the top, the weaker ones drop down, and the list gets updated constantly. A stock market index works the same way. It's a running list of companies that represent a slice of the market, refreshed regularly to reflect which companies are currently the strongest or most relevant. Because passive ETFs simply follow a formula rather than paying a team of analysts to make decisions, they tend to be remarkably cheap to own. This ongoing cost is called the expense ratio, and for passive funds, it typically falls somewhere between 0.03% and 0.3% per year. You never see this fee show up as a line item on your account. It's quietly subtracted from the fund's value over time. So if you had $1,000 sitting in a passive ETF with a 0.05% expense ratio, you'd be paying around 50 cents a year. That's about as close to invisible as a fee gets. Within the passive category, there are several popular flavors worth knowing. The first is funds that track major domestic markets. In the US, that usually means an index made up of roughly 500 of the largest publicly traded companies, spanning everything from tech giants to healthcare and financial firms. Historically, an index like this has returned somewhere in the neighborhood of 8 to 10% annually over long stretches of time, though any given year can swing well above or below that average. Next up are international funds, which look beyond domestic borders to companies in developed regions like Europe, Japan, Canada, and Australia. A well-known example tracks an index covering more than 1,000 companies across roughly 24 developed economies. Interestingly, because the U.S. economy is so dominant globally, American companies often still make up a large chunk of these international funds, but you still gain meaningful exposure to other mature economies around the world. Then there are emerging market funds, which target countries still in earlier stages of economic development, places like India, Brazil, China, and various nations across Southeast Asia. These markets often carry more growth potential because the companies inside them have more room to expand, but that upside comes paired with more volatility and unpredictability along the way. Rounding out the passive lineup are small company funds, sometimes called small cap funds. These track businesses that are smaller, younger, or more niche compared to the household names you'd find in a large index. They can be bumpier rides, reacting more sharply to economic shifts, but they've also historically delivered strong returns over long time horizons. Buying a small cap fund means you're spreading your bet across hundreds of these smaller companies at once, rather than gambling on just one or two. Now, let's flip to the other side of the management spectrum, active ETFs. Unlike their passive counterparts, these are steered by professional fund managers who are actively trying to beat the broader market. They're constantly researching, forecasting, and adjusting the fund's holdings based on their own analysis and strategy. On paper, that sounds appealing. Who wouldn't want a professional working to squeeze out extra returns? But here's the catch. Outperforming the market consistently is genuinely difficult, and history shows that many actively managed funds fail to beat their benchmark over long periods. On top of that, you're paying a premium for that active management. Expense ratios on these funds often climb above 0.5%, sometimes even reaching 1% or more. So, with active funds, you're taking on higher costs without any guarantee of higher returns. Beyond the passive versus active divide, ETFs can also be sliced by sector or by company size. Sector funds let you zero in on a specific industry like technology, energy, or banking if you have a strong belief that a particular corner of the market is about to take off. Similarly, some funds group companies purely by size, whether that's large, mid-sized, or small businesses. And just like the broader categories we covered, these sector and size-based funds can be either passively or actively managed, so it's always worth checking the fund's description or fact sheet to understand exactly how it operates. The final lens to consider is how a fund handles dividends, which are simply the cash payments companies distribute to shareholders. Some funds are distributing funds. They pass those dividend payments straight to you, usually on a quarterly basis, which can be a nice source of regular income. Other funds are accumulating funds. Instead of paying you out, they automatically plow those dividends back into the fund itself, quietly compounding your investment in the background. One thing worth keeping in mind is taxes. In many places, dividend income is taxable the moment you receive it, so an accumulating fund can sometimes be more tax efficient simply because you're not collecting a cash payout in the first place. That said, the right choice really depends on your local tax rules and the type of account you're investing through, so it's worth double-checking before you decide. Before you actually buy your first fund, there are a few practical steps to take care of. You'll need a brokerage account, and it's worth shopping around for one that's beginner-friendly, charges low, or no trading fees, and gives you access to the specific funds you're interested in. It also helps to get clear on your why. Are you investing for retirement decades away, or do you might need this money sooner? Your timeline should shape how much risk you're comfortable taking on. And finally, let's cover a few common traps that catch new investors off guard. The first is chasing recent performance. Just because a fund had a great run last year doesn't mean that trend continues. And a rough year doesn't mean it's doomed either. Always dig into the fundamentals rather than reacting to headlines. The second trap is ignoring fees. A 1% expense ratio might sound tiny, but compounded over decades, it can quietly eat away a shockingly large chunk of your total returns. The third mistake is putting all your money into a single sector or region. Even though ETFs are diversified by nature, concentrating everything in one area still leaves you exposed if that area underperforms. And the last one is simply not understanding what you actually own. Before you invest a single dollar, take the time to look under the hood. The companies, the regions, the strategy. And if a fund feels too complicated to explain in a sentence or two, it's probably worth choosing something simpler instead. That wraps up everything you need to feel confident taking your first step into ETF investing. If this helped clear things up, drop a like and consider subscribing. It genuinely helps this channel grow. Thanks so much for watching, and I'll see you in the next one.